SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to this SUERF BAFFI Bocconi workshop today, which has been designed and set up in close cooperation with the National Bank of Slovakia. Today, we will discuss key findings from the latest 2021 wave of the Household Finance and Consumption Survey, HFCS, of the Eurosystem and the ESCB. Without further ado, I hand over to Reiner Martin.
Thank you very much, Ernest, and let me also welcome you on behalf of the Slovak National Bank to this workshop. So let me just say a few words before we get started with the program. I suppose most of those who have joined us now are familiar with this project, but let me nevertheless give a brief introduction just to set the scene, so to say. So the Household Finance and Consumption Survey is a triannual survey coordinated by the ECB and carried out in 22 ESCB or EU countries. Its main objective is to collect harmonized data on household finances, on the allocation of household assets and liabilities. And it's a very resource-intensive survey. I think that shouldn't be forgotten when we talk about the nice results today and how useful it is. So each wave takes around 3 years to complete. And in a way, you can say that it's a survey that never sleeps. So with my colleagues in Slovakia, they were busy writing the report, and at the same time, they were also already very, very busy preparing for the next wave. So it's overlapping at times at least, and it requires a lot of input. But I think it is certainly worth this input because the HFCS microdata has found to be very useful to address a lot of important policy questions. And let me just mention two of them. So the first one is the ability to better assess the distributional impact of monetary policy on household balance sheets. And I think this is very, very important, especially now when monetary policy is very active again, so to say. It also helps to identify risks in financial stability sphere by getting a clearer picture about the riskiness of households' financial positions. Now, going beyond these policy questions, which are, of course, very, very important, the data has also become very popular with academics. And there's been quite a number of HFCS-based research pieces that have been published in very highly regarded and prestigious journals. So just to mention just two of them, the American Economic Review, but also the Journal of Finance. Participating central banks, as well as the ECB, have also been quite active in promoting early access of this data and comprehensive access to this data for students, for educational purposes. And in Slovakia, for example, we are very active in promoting financial literacy. That's an important project by the NBS. And the HFCS data provides also a lot of useful insights in this regard. So the latest wave of HFCS data, the one that we are now talking about, has also been covering a very turbulent, I should say, but also, of course, very, very interesting economic period. So first of all, it's an area where we can see now whether European households have benefited from the unprecedented growth in real estate prices. And we can also see how they reacted to the economic implications of the COVID pandemic. And also the early stages of the current bout in inflation is something that is already reflected in these data. So in the workshop today, we will start with a presentation of these effects from the euro area perspective. And our colleague Jirka Slacalek will start with this. And I will introduce him in a minute. And then we will subsequently deep dive into the implications in 6 of the participating countries. Now we've selected them based on certain heterogeneity within this country group. There's a couple of important dimensions. One of them is the degree of home ownership that plays a big role, of course, in the results and in the interpretation of the results as well, and also the degree of per capita income. There are quite some differences in this field too. So this part of the workshop will be chaired by my colleague Ján Klasco, also from the Slovak National Bank. So before finishing these brief introductory remarks, let me briefly introduce the first speaker, Jirka Slacalek. So Jirka is with the ECB and he's with the Monetary Research Division of DG Research, and he has been there for quite some time, actually. So he's currently senior lead economist in this division. He has published very widely in a number of areas, and one of the most important ones is, of course, household finance and consumption, not surprisingly. So he is really the right man to talk about this today. So Jirka has 2 master's degrees, one from the Charles University in Prague and one from Johns Hopkins University in Baltimore, where he has also completed a PhD. All right, on that note, let me stop here, and Jirka, the floor is yours. Thank you very much.
Thank you so much, Reiner, for this introduction. I would also like to thank SUERF and Bocconi for organizing this interesting webinar, and in particular colleagues from the National Bank of Slovakia, so Reiner, Ján, Andrej. Let me start the presentation focusing on the main facts of the euro area countries, focusing on the results from the 2021 survey of household finance and consumption. So this work is based on joint work of many colleagues from national central banks and national statistical institutes of the euro area and some non-euro area EU countries represented in the household finance and consumption network. And it will focus on the changes on the new wave of the household finance and consumption survey, and especially comparison with between the 2017 and 2021 results. So what is the household finance and consumption survey, the HFCS? It is the best source of cross-country comparable microdata on household wealth in the euro area and euro area countries. It is consisting of a comprehensive set of a common list of output variables, focusing on a very detailed qualitative and quantitative description of wealth components, so assets and debt components. It also covers household income and includes indicators of consumption and credit constraints. The 2021 wave, which we have released in July, has been the 4th wave. So there has been following a roughly three-year cycle, and the next wave is already ongoing in many countries. It's a very large data set. It covers it includes information on 83,000 households interviewed in 22 countries, which cover the euro area and include the Czech Republic and Hungary. The survey follows the probability sampling, which is used in all countries. And importantly, in most countries, it includes the oversampling of the wealthy, which is of course important to improve the coverage of the very top tail of the wealth distribution, because as we document in the survey, wealth is very unevenly distributed across households. So it's important to also cover the richest people in the economy, so that we have a good picture of the overall distribution of wealth in the macroeconomy. And importantly, also for researchers, we have had an expanding dimension of the panel data set implemented in 13 countries. This means that we follow the same households across different ways, which is very useful for analytical purposes when we want to follow and analyze changes in household wealth within individual households, or transitions, for example, from employment to unemployment. The main results that I want to start my presentation with main results on changes and comparison between 2017 and 21, which are included in the results report released in July, and then I will add a few more analytical findings which could be relevant for future research work and analytical work, and also relates to the two areas that Reiner has mentioned earlier on the impact of distributional impact of monetary policy and financial stability. So as far as main results are concerned, we have documented a rebound of net wealth, reflecting strong gains across the net wealth distribution, specific at the euro area level, specifically a 13.3% increase in the median net wealth, 13.1% increase in the mean. But there has been quite substantial heterogeneity in growth rates across various groups of households. As far as real income deflated with HICP is concerned, we have recorded quite broad-based real income gains at the euro area level, specifically 3.2% for the median household and 3.8% for the mean household. We have also documented some decline in various indicators of financial vulnerability. So for more household groups, there have been declining debt to asset and loan to value ratios. There have been quite stable debt to income ratios and debt service to income ratios. We have also documented some reduction in the debt to income ratios at the bottom tail of the income distribution, so for low income households. And there has been relatedly, there has been some decline in the share of adjustable rate mortgages, specifically from the 46% in 2017 to 42% in 2021. Overall, the net wealth inequality has been stable, with reflecting some reduction of inequality in the lower half of this distribution and a small increase in the upper half, upper tail of the distribution. Let me now illustrate, just as a main focus of the survey, let me illustrate the structure of the balance sheet of households across net wealth quintile, across the wealth distribution. So this chart shows the structure of assets and liabilities. So we cover the various real assets, household main resident as the most important asset for most households, other real estate, additional houses, and self-employment business, and then also financial assets. And on the other hand, on the liability side, we have a total debt consisting of mortgage debt and non-mortgage debt. So what we see here is that there is a substantial increase in assets with the quintile of the wealth distribution. So assets increase much more substantially than debt. Specifically, the mean value of assets at the top quintile, the top 20% at the euro area level exceeds 1 million euros, while debt is much less than 100,000 euros. We see that the real assets are very important for most households, specifically the household main residence in dark blue is quite substantial. And then together with the other real estate, additional houses, these real assets make up about 60% of the value of total assets. And this share is actually quite stable across the distribution of wealth. But we also see that portfolios are in general not very diversified. So the main asset is the household main residence. And there is a bit of evidence of a bit more diversification for the rich people who have a higher, who also invest in more in shares, financial assets. But in general, there is not too much diversification across portfolios of households. Let me now document the time series pattern, the changes and profile in the dynamics of income and wealth. So over the 4 waves, so starting in 2010, focusing on the last of the changes between the last 2 waves, between 2017 and 21. So these charts on the left document the changes in the distribution of net wealth, focusing on the median and mean. So what we see is that the median net wealth, the wealth held by the kind of household in the middle of the distribution, it's much lower than mean net wealth. But for both indicators, we see that there was quite a rebound in the net wealth after 2 years in 2014 and 17 of lower values. We see that mean and median both increased by about 13%. There was on the income side, there was quite a broad-based increase in income of about 3 to 4% for the median and the mean of the income of the gross income distribution. Let me now move to 3 additional results just to stimulate thinking and document some of the facts that I have put in the summary early on. So let me focus on 3 selected additional results. And then, of course, the data set is very rich. And as Reiner said, we have been very keen to share it with researchers and students across many institutions. So we're very happy if there is more work done to analyze this very rich data set. So the first set of results focuses on to document the deleveraging of poorer households, especially driven by the higher assets. So we see that this chart shows distribution of net wealth, focusing on the 3 groups: the bottom half, the middle 40% between 50 and 90 percentile of net wealth, and then the top 10%. What we see here is that we're focusing on the ratio between total debt and total assets as a measure of leverage, or how much assets people have to cover their debt commitments. So what we see here is that there is some decline in between 2017 and 2021 across all 3 groups of households, and specifically the decline is quite substantial for the bottom of the wealth, for the bottom half of the net wealth distribution. So we see that there basically there is quite substantial decline, about 20% decline in this indicator of leverage. There is the decline is much smaller at the top of the wealth distribution. And this decline is mostly driven by the accumulation of assets, so by the denominator of this ratio. So basically, households, especially in the lower parts of the wealth distribution, have been able to accumulate additional assets that help them cover the total debt. And this is reflected in this chart. So this chart focuses on total assets, which include both financial assets and housing, which is an illiquid asset. But we also document a similar pattern, focusing now on a different indicator, documenting the leverage, specifically debt service over liquid assets. So this is a relevant indicator for the households who wanna cover their debt commitments by liquid assets, because they don't need to. Sometimes it can be hard to change the holdings of illiquid assets like housing. But we also see in this chart that there has been a substantial decline in this indicator for liquid assets, so reflecting the increase in increased accumulation of liquid assets at the bottom half of the distribution of net wealth. The second fact that I wanna illustrate, just to stimulate your thinking about the implications for monetary policy more than for financial stability, is about the share of so-called hand-to-mouth households. So these are households who have relatively limited assets, liquid assets relative to their income, and this share has been found an important indicator also for when constructing our macroeconomic models, because these hand-to-mouth households were found to be their consumption was found to be very sensitive to adverse shocks to income or wealth. So a higher share of hand-to-mouth households basically suggests that the economy is less responsive. The consumption spending in the economy is more responsive to the shock. So specifically, the hand-to-mouth households hold less than 2 weeks worth of income in their liquid assets, and they can either be poor hand-to-mouth households who do not own real estate, or wealthy hand-to-mouth households, the households who own housing but do not own much of liquid assets. And in this chart, we document that at the euro area level, there has been a decline since 2014 in the share of the hand-to-mouth households. So it has between 2014 and 21, it has been going down from about 22 to about 17%. And this has been also basically in line with the previous chart documenting the increase in holdings of liquid assets in the lower parts of the distribution. So basically, as households have been accumulating additional liquid assets, the share of the hand-to-mouth households have been going down, and this suggests that the economy could be some more less responsive to adverse shocks in terms of the reaction of consumer spending. A separate but related fact is illustrated on the right-hand side, basically reflecting the so-called marginal propensity to consume out of transitory income. So we have a specific question asking about hypothetically, if you receive 1 month worth of a lottery gain, how much would you adjust? By how much would you adjust your consumption? And we see this question is quite useful for measuring the response of households' consumption to this income or wealth gains. And what we see here, so we have had this question for 2017 and 2021. What we see here is that there has been some decline in the marginal propensity to consume from about 46 to 42% at the euro area level, and also for most countries. So this documents that basically the marginal propensity to consume on average is about 46%. So about households would consume about somewhat less than half of the gain in income. And then this marginal propensity to consume has declined between 2017 and 21 for most countries. Finally, the third chart documents the so-called net nominal positions, the exposures to inflation risk of households, comparing again the 2021 and 2017. What we illustrate here is the breakdown by age. So starting from the households younger than 35 years, and then following the 10-year groups until more than 74 years. And then within each group, we have a breakdown by 5 income quintiles. So what we see here is that this net nominal positions, which is essentially nominal deposits net of total debt, they are strongly increasing with age. So younger households tend to have mortgages, while older households have repaid mortgages and tend to have nominal deposits. And also these net nominal positions are increasing with income. So what we see here is that essentially younger households then would somewhat benefit from unexpected inflation shocks, while older households would lose due to the lower value of their net deposits. And comparing the 21 to the previous wave, 2017, we see that there has been an evolution in these net nominal positions, specifically that in 2021, the green lines for the top top income quintiles have been a bit higher than for the 2017 wave. So basically, we can use the survey to document this fact that especially households at the top of the income distribution have been accumulating additional nominal assets. Let me now conclude with my presentation. This was just a small series of kind of facts to stimulate your further research and work with the data. Of course, as I said, the data set is very rich, and it includes microdata at the household level. So there can be a very detailed analysis done in many areas. And we are very happy to share the data set with researchers, students, professors, so that they can analyze the distribution and structure of household wealth and focus also on the differences across individual European countries, which makes the data set very easy to apply. Thank you very much.
Well, thank you very much, Jirka, also for excellent timekeeping. So we have a few minutes left in this first part of the workshop. So far, there is nothing in the chat, but maybe people still have questions. In the meantime, let me start with one question, if I may. I found your slides on deleveraging very interesting. I think it was slide 9 and 10. And in particular, there's quite a decline between the last two waves. And for the bottom 50% of the distribution. And I mean, maybe this is just a coincidence of timing, but this correlates with the period when macroprudential policy has really taken off in many euro area countries, and a lot of measures were taken. And I just wonder whether this is something you looked at all, or whether you have any insights into this issue, to what extent this sort of macroprudential policy could have played a role here?
So we haven't had time to specifically drill into the drivers of this of the changes, because the changes have been particularly strong in the last wave between 2017 and 21. So we just released the data. In fact, then I think it's also a good good question to analyze for basically anybody now that the data are available. We have found that one driver was this accumulation of total and liquid assets. So basically, there was this fact that perhaps also following the COVID time, and people have been able to accumulate some excess savings as their consumption was sometimes limited. So that was one factor. But also at the kind of liability side, it could be that that some of the households also were affected by these macroprudential measures. But also, it's the charts that I showed was basically at the euro area level, so it's very aggregated chart. So I think this cross-country differences in macroprudential measures, and also the accumulation of liquid and total assets adjustments in total debt. I think this is a very interesting and important question to consider.
Okay, thank you. Yeah, I may be biased here because, as you know, Slovakia has been, of course, very active with macroprudential policy. So we have, in the meantime, received some questions here also in the chat. Let me just read it out. So there were two questions. The first question is, would the metadata summary document be made available soon as in the previous waves? Okay. It will be useful to have the table as usual with the reference period, income and asset questions. Okay, I think that's just a factual question. Do you want to reply?
Yes. So we have released together with with the microdata, the large data set. There is also the usual kind of set of large, quite detailed set of tables at the Household Finance and Consumption website at the ECB. There are the 3 reports. My sense was that there is quite a detailed documentation also related with together with the microdata. So I think this should be done in the same way as we did for the previous wave, waves. Yeah.
Okay, great. And the second question is, have you checked the correlation of the MPC question answer for the panel households between wave 17 and 21?
So so that's a very good question. So actually, this has been like the fact that the MPC, the marginal propensity to consume, has been used repeatedly. I think it's quite useful. There has been articles published, for example, for the Italian data. So we haven't looked in detail into this question, but this would be something definitely to dig into. So also about the distribution of marginal propensities to consume. So it's very actually it's quite nice that we have this information about marginal propensities to consume at the household level, and then you can look how it correlates with various household characteristics. One of the important questions and relevant questions would be, to what extent it's stable at the household level, and if not, maybe it's related to some observable characteristics. Maybe households accumulate liquid assets and their marginal propensities to consume go down. So this would all be very valuable to know.
Okay. Thank you. And then there is a next question about whether the results are driven by differentials in the timing of the field work, which is of course different from country.
Yes. So to some extent, this could be. So there are differences in the field work, and for example, for income, we know that there has been different fiscal packages, specifically in this period, that have been during different times. I think the indicators for wealth tend to be kind of more stable, especially during this period, because basically in general wealth is a more slow-moving variable because it's a stock variable. And if we look at aggregate data, for example, on house prices or even stock prices, there has been quite stable at this kind of horizon of within 1 year, that kind of we have these differences in interview and in the fieldwork periods. So this is something that we are working on, and we are trying to synchronize more the interview periods across countries, which would indeed be very valuable for research and future work.
Wonderful, thank you. So we have 2 more questions, and then I think I close it for this part of the workshop. Thanks for being so active. This is great. So next question is: do we have a breakdown of household debt into cross-border and local?
So we don't have this breakdown we don't have this breakdown at the euro area level. So at the country level, there are additional questions which may help analyze this issue. Of course, if you're thinking about the main sources of that, so if you're thinking of mortgages, typically it's related to real estate, which is within a country. So similar, I think, for most of the non-mortgage debt is kind of local. That will be my guess. Yeah. But we cover in quite detail differences within various debt items: mortgage, non-mortgage, household main residence, other real estate, credit cards, consumer credit. So this is what we cover at the euro area level at a comparable way across countries. Yes.
Yeah, I mean, given that banking is still largely national in the EU, I think that I would agree with that fully. Okay, and the very last question then is on the reliability of median debt service to income ratios for some countries in the bottom quintile.
Mm-hmm. So in general, we do quite substantial checks for the various series. So there is quite a detailed cross-check before the data are published, both at the country level and at the ECB level. We cross-check with various micro level data sets, the survey of SILC, the survey on statistics on income and living conditions, other surveys, also the aggregate data. So there is a reasonably good match with these additional sources. Of course, so for this specifically for this median, so in this chart we have been focusing on this median statistics, which are not very, which are quite robust to changes in to outliers. So basically, then this is something to be aware of, that there can be differences between a median and mean. Of course, for smaller, for countries with smaller sample sizes, then some statistics, especially the ones focusing on the tails or the part of the small subgroups of the distribution, are subject to statistical errors. So we also document in the tables. We quite consistently document the standard errors related to these various statistics, including the median debt service ratios, also at the country level. So these standard errors are reasonably small at the country level, but then of course one needs to be careful when if you want to look at specifically the fine household breakdowns. So then one needs to keep in mind how to have adequate sample sizes.
Okay, thank you very much again, Jirka, for excellent presentation and for great questions and answers session. And on that, I would pass the baton on to Ján for the second part of the workshop. Thank you.
Thank you.
Thank you very much, Reiner. And first of all, I would like also to thank to everyone who was involved in the organization, and also to everyone who joined this workshop. As the devil is in the details, therefore I'm glad that we will have now 6 country-specific presentations from really countries with a bit different household asset and liability structure. We are going to have the presentations in the declining order of home ownership in the different countries. So we start with Slovakia, where the home ownership based on the latest HFCS data is almost 90%, and we end with Germany, where the home ownership is a bit less than 45%. Regarding the organization, so we will have first 3 presentations, then we will make a question and answer session, and then we continue with the next 3 presentations. The first presentation will be held by Andrej Cupák, who is a senior researcher at the research department of the National Bank of Slovakia. His research interests are in the area of empirical household finance, with a particular focus on the role of financial literacy in financial decision making. His research has been published in journals such as Economic Letters, European Journal of Finance, or Oxford Economic Papers. He's also an advisory board member of the Luxembourg Income Study. So, Andrej, the floor is yours. Please go ahead.
I also would like to thank to the organizers to organizing this interesting webinar, and also to other colleagues from the other central banks to agreeing to join this event. Obviously, I would like to present the results of the latest HFCS, which was done in Slovakia in 2021. And HFCS usually is a joint work of a larger team. So we consist of 3 members, so myself and colleagues Anna Strachotova and Judith Strachotova, who substantially contributed to this project. But I was asked to present the results, and obviously the standard disclaimer applies, that these are just my opinions and not of my employer. Okay, so actually Jirka already provided a quite nice summary what the HFCS is about. I maybe will just add some country-specific features to it. And we do HFCS as a national, so we administrate the survey as a National Bank of Slovakia, and we do it together with the Slovak Statistical Office. We joined this project in 2010, and on a triennial basis, we basically conduct the survey. And as it was already stressed or highlighted, that's one of the most comprehensive surveys that collect harmonized information on assets, liabilities, income, consumption, some other socio-demographic characteristics. And if it comes to the specific features of the latest wave, so yeah, we also basically follow what is the state of the art within the network. So the sample or design is a random probability sample, and we, as it was already told, it's very hard to get some specific groups of households into the survey. So we do some we make some attempts to get the wealthy households in the survey, but I must say that it's not an easy task. You know, sometimes we manage to do oversampling like more effectively, sometimes less. So we are trying to do our best, but yeah, it's important feature, but it's not an easy task here. So as many countries faced the outbreak of COVID-19, so we were also among them who sort of had to postpone the field by a couple of months. So that's why instead of 2020, we actually started in 2021. I must say that we did it via pure copy mode, so we didn't have to switch to some alternative mode. So in this regard, we were quite consistent across the waves. Response rate in Slovakia, I would say, is fairly good. It's around 55%. So out of 3,900 sampled households, more than 2,107, around 2,200 households actually completed the survey. Since last actually 2 waves, we already tried to monitor the situation among repeated panel households. So we have some panel subsample for almost 900 households. And as it's usually the case, so we do not only collect the harmonized set of variables or questions, but we are free to also include some country-specific information which we would like to collect. So yeah, there was this special module on COVID effects, which more countries join this module. We do monitor financial literacy of respondents over time. There are some questions on subjective well-being and economic expectations. So yeah, so about the usefulness of the data. So yeah, I would say and agree with Reiner, the data is, and also with Jirka, the data is very useful in several ways. So for instance, we built a lot of policy analysis based on the HFCS data, which usually were part of the financial stability reports. The data has become very popular among researchers in Slovakia too. So there are some working papers published in our working paper series. Academics also publish in journals with HFCS data. And importantly, we also try to educate data users from time to time. Almost every 2 years, we try to organize HFCS data workshop. Okay, so today I'll just pick up several facts and results which I will be going through during the presentation. So I'll just briefly say something about the distribution of wealth in Slovakia. I would then obviously focus on the particular components and mostly real estate assets, as it has been already highlighted that that's the most important component of household assets and wealth in Slovakia. I will say something about the indebtedness of households in Slovakia, and also say something about the evolution of financial literacy. All right. So let me start with the evolution of median household net wealth, which is obviously the difference between real and financial assets, less the liabilities, and between the last 2 waves, between 2017 and 2021. So the nominal median household net wealth value increased by almost 40%. From 70,000 to 97,000 euros. And later on, you will see that it has been mostly related to the increase, a large increase in real estate or house prices. Jirka mentioned that that the inequality in wealth roughly remained the same across, broadly looking at the euro area. But actually, Slovakia belongs to a set of countries where the wealth inequality basically, I would say, substantially decreased, and this was mainly driven by a relatively larger increase in wealth situation of low-income households and also younger households. And here you can just see the distribution of net wealth across main regions in Slovakia. So here you can see some differences from the region of capital, Bratislava, where the median net wealth is around 134,000 euros. And the least developed region in this regard, or the poorest region, is the region in central Slovakia, Banská Bystrica, where the net wealth is around 70,000 euros. Okay, so obviously the wealth consists of assets on the one hand. So let me just show you the time series, how the participation rates evolved over time. So here you can see that over the 4 waves, the share of households who own the household main residence remained quite stable, close to 90%. And the light blue bar indicates the evolution of the ownership of other real estate, and it has been slowly increasing over time. If it comes to financial assets, so basically the top right figure, there you can see that also the ownership rate of deposits is very large, around 90%. And if it comes to more sophisticated assets such as shares, bonds, and mutual funds, which is indicated by this brown bar, there we can see, maybe it's not visible, but actually it's a little bit growing over time, and in the latest wave it was around 6%, but which is still like a very low number in comparison to other developed countries. Yeah, so yeah, as I told, that the increase in net wealth was mostly attributable to an increase in the value of real estate. So here in the bottom left part, you can see the evolution of the household main evolution of the value of the household main residence by the navy or dark blue color, and this is actually the conditional median value. Okay, and also the evolution for the other real estate, and you can also see the evolution of values in the particular financial assets. Yeah, I mean, despite it looks that it's increasing, but since the you know the fraction of households who own those sophisticated financial assets such as stocks, bonds, or shares is very low, so you know this conditional increase does not really translate to substantial increases in wealth levels. So I think that this picture quite nicely illustrates that yeah, I mean, virtually Slovak households become like substantially wealthier, but this is obviously caused because that the vast majority of their assets is held in their main residence and also the other real estate. So unfortunately, Slovakia is among the countries where the importance of financial assets in general and sophisticated financial assets in particular is not so visible, and it generally holds across the whole distribution of economic resources. So here we look at the deciles of household income, but this picture would look quite similar if we would plot these relative contributions, let's say, across the wealth distribution. Okay, so since real estate or ownership of HMR is so important in Slovakia, so obviously we need to verify the reliability of answers, because generally households can say anything, right, in the survey, because it's just their subjective evaluation of the prices. But here we can actually align those subjective house price responses within the HFCS, which is the y-axis, and then on the horizontal x we were able to calculate some benchmark prices from some other data source from Slovakia, from some transaction data. And here we can see that the two were quite well aligned, especially in the 2017 in the majority of the regions in Slovakia. Okay, so this data, these dots are regions. Obviously, the region of Bratislava is a little bit different story because it's a capital. It's a little bit different dynamics, you know. So obviously, households a little bit underestimated the price in 2017, and this there was some further divergence in 2021. But you know, we can conclude that the prices which they give are sort of, I would say, reliable. And if it comes to the ownership of real estate, so we have some nice questions on the actual expectations of households about the future house prices evolution. And these two figures actually are quite nicely connected, I would say. So this is based on a question where households would need to allocate some possible scenarios to what would happen to the value of their household main residence in 1 year, in 12 months. And we can see that actually in 2017, where the real estate market was quite, I would say, well, stable or not so dynamically changing. So you can see that around 40% of households assume that within 1 year, the value of their dwelling would increase on a rate between 2 and 5%. And actually, the official increase, the year-on-year increase was quite well aligned with their expectations. It turned out to be 5.2%. But then going forward to 2021, so we asked the same question to households, not necessarily to the panel households. Okay, so this is the pure cross-sectional picture, and there we can see that the distribution, okay, a little, well, shifted to the right, but still there was a big mass of households who actually assumed the same increase. So obviously, you know, there are different theories or mechanisms how this can be explained. So obviously, one relevant theory that kicks in is obviously this rational inattention, and especially this may be especially relevant for Slovakia since ownership of real estate is very like illiquid. So maybe, you know, households they buy the apartment or the dwelling and have it for the whole life. So maybe they are just not in it. They are just not attentive to the dynamics, what's going on the market. And since we have like very interesting characteristics collected for households, I didn't have space to put all the results here, but what I can tell you from the tables which are published in our country report. So this, if you would look at this dark brown bar, which basically indicates the increase by more than 5%, and it's an open bracket, so it could be anything more than 5, right? So this share is higher for those groups of households who are generally highly financially literate. Yes, so that's maybe an interesting correlation. And there are also some differences across age or income groups. So yeah, this is I think quite interesting results. If it, you know, because so as I told, it's typically the only asset which households own. So maybe they should also pay attention to, you know, to what's going on the market and possibly how, you know, the price will look like in the future. All right, so obviously one way how to acquire or finance the asset is via debt, especially mortgage debt. So here I show the time series about the evolution of the indebtedness, and you can see that overall indebtedness, which is given by the light blue bar, is sort of increasing over time. And it was especially true for the participation in mortgage debt, which increased over time. And in 2021 wave, it was around 20-25%. And if you would look or zoom in specific household groups, so in the top right figure, you can see the evolution of the participation in the mortgage market across the age cohorts. And here you can see that especially young households between 16 and 44, the participation in mortgage market is substantially increased. Yeah, so here I again show, which has already been discussed by Jirka and also some other follow-up questions in the chat. So yeah, here I show the evolution of the median debt burden indicators, DTI, DSTI, and loan to value. And yeah, I mean, overall, I mean, level of indebtedness is sort of increasing, which is in line with the above pictures. But if you look at the indicators like DSTI and LTV, so these have become rather stabilized over time and are not growing. So yeah, that's a question, and we haven't carried out any sophisticated analysis with the data, whether it's a consequence or the reaction to the tighter macro proof. All right, so yeah, we collected some set of questions on the effects of the pandemics on a household financial situation. Yeah, there were like a couple of questions, but I chose to show you the impact on the financial wealth. So basically, the question asked like if your financial wealth decreased or remained similar or increased as a reaction to sort of COVID pandemics. And here you can see that among the age groups, it were mostly younger household groups who were impacted the most. But still, the effect was not so severe. Okay, and if we would look at the employment status, there the result is in line with the expectations. So it were mostly like self-employed households who were impacted the most. I mean, in negative terms. Okay, as a reaction to COVID. There are almost 40% of households who were like self-employed. They would say that their financial wealth decreased as a reaction to COVID. Okay, and the very last result, which I would like to show you, that yeah, so we tried to collect and monitor level of financial literacy in Slovakia already since 2014, where we basically in three waves, in three consecutive waves, we ask questions, the standard questions, which are motivated by Lusardi and Michel, who are pioneers on this research on financial literacy. So we ask questions on interest rates, inflation, diversification, asset risk, and you can see in this chart on the left that you know the particular questions, some of them are understood quite well, some of them are not understood at all, and combined here in the very last set of bars, you can see the overall financial literacy score, or basically the share of households who could answer all four questions correctly. And that number is quite low, because there are some similar studies or similar other surveys out there. And for instance, the share of households who understand such similar questions correctly is, if I remember correctly, in the survey of consumer finance is much higher. It's something maybe around 40-50%. And obviously, we want the population to be financially literate, because they can make better, you know, investment choices. And here I just wanted to illustrate the association or the correlation between the level of financial literacy and the probability of holding these sophisticated financial assets, such as shares, bonds, or funds. Yeah, obviously this relationship is generally very endogenous, so this is just a correlation, and typically we would need to address the endogeneity issue in regression analysis. But this picture already shows that there might be some returns to financial literacy. And this is the last thing which I wanted to share with you. And yeah, if you're interested in our country webpage or country report, you can just click, you can just download it here, and you can also request the data if you're interested in Slovak country data.
Okay, so thank you very much, Andrej. Thank you very much for the first presentation from the country. So in sake of efficiency, so let's continue immediately with Italy. So quickly introducing David Loschiavo, who is the presenter. He has been working at Banca d'Italia since 2007. He joined the Household Finance and Consumption Network 2 years ago when he became coordinator of the survey on income and wealth, the Italian leg of the HFCS. As an economist, he has authored articles and papers on income and wealth inequality, household finance, firms' access to credit, urban economics, happiness, and the history of economic thought. So David, please, the floor is yours.
Thank you, Jan, and thank you, the organizer, for having me. I will present the main results of the Household Finance and Consumption Survey for Italy. Following this outline, I need the first couple of slides, hopefully not that boring or tedious, on our national survey, but mainly to introduce some methodological changes that have been implemented in the last wave that are important for the discussion of the following results. Then I will turn on the description of trends in income and income inequality. I will highlight the role that income support measures have played in shaping those trends, and then I will turn on the main results on wealth, liabilities, and financial fragilities. So the survey on household income and wealth is the Italian leg of the HFCS. This has been carried out by the Bank of Italy since the mid-60s. In the last decades, every 2 years, we have a panel, a sample of 8,000 households and a panel component since 1999. The methodology that we adopt is of in-person interviews. Our data are available on the internet. We have a time series since 1977. Due to pandemic in 2021, we adopted for the first time a mixed data collection mode. So with both in-person interviews and telephonic interviews, in particular for those households that were more reluctant to host at their home an interviewer due to the pandemic. We have seen a very low participation rate, nearly the half of the usual one. We ended up with 6,000 households interviewed. Let me stress that traditionally, the reference period for, in our survey, the reference period for income and wealth is the year preceding the fieldwork. So in our case is 2020, the year. As I was saying, in the last wave, our survey has undergone some significant methodological changes to improve the statistical coverage of high income and indebted households. Indeed, most of the countries participating to the household finance and financial household consumption and financial survey adopt some sort of oversampling of the reach. There are some differences among surveys, with some of them using direct information such as administrative data, and other ones using indirect information. Anyway, this was not the case of Italy. The reason being that we hadn't access to the relevant administrative data. We overcame this issue thanks to an agreement with our National Institute of Statistics. Now the sample of households to be interviewed is selected not only on traditional demographics, but also on households' level of income and of debt. In this way, we are able to observe a segment of the population that, despite being rather small, hold proportionally higher share of the core variables, and thus this allow us to paint a more accurate picture both of aggregate values, as you can see in this figure, in this slide, but also of their distribution across the population. As often happens, these improvements came with some costs. In particular, previous survey findings are not directly comparable to those of the last wave because of the new design. So in other words, we have a break in the time series to deal with. So what we have done is to have a double weighting schemes with the two sets of weights. The first one that we call the weights for historical comparison are to be used for description of trends, and they are obtained by approximating the composition of the sample that would have been obtained without the changes made to the sampling methodology. And then we have the new design weights that are to be used for cross-sectional values and that allow us to take full advantage of the greater accuracy of the new sample design. For the user of our survey, just an alert, because as I said, traditionally the time span between two waves was 2 years, but this time also because of COVID is longer than usual. So we are commenting trends between 2016 and 2020. So please keep this in mind in the following. So let's get started with the results, in particular with the income that was higher than the level in 2020 was higher than the level recorded in 2016, both in terms of mean household income and also in terms of real equivalized income. Yet both measures were well below the level reached in 2006 before the last three recessions that hit the Italian economy. The intensity of the increase in income was not uniform across socio-demographic and economic groups. In particular, the mean value of the first and the fifth quintile of the equivalent income distribution grew more than the central quintiles. And the striking increase in the first quintile is due to social transfers, and is also mirrored by this big jump in the mean income of households whose reference person is not working. So let's have a look at those transfers. They were of mainly two kinds, or at least they can be grouped in two kinds of transfers. Those introduced between 2016 and 2019, so before the pandemic, and that at that time were meant to be permanent. I'm talking in particular about the new minimum income and pension schemes, in Italian reddito di cittadinanza e pensione di cittadinanza, and those temporarily adopted in 2020 to cope with the pandemic. Overall, all these transfers amounted in terms of households' monetary income a share which is double to the one recorded in 2016. So we are observing a sizable transfers. They were received by almost 25% of households, but the greatest impact stems from the new minimum income and pension schemes that, despite being received by only 4% of households, they made up for 2/3 of the recipients' income. Thanks also to these measures, the pandemic had a limited impact on inequalities, and here we can see the red line is the Gini index, that the net of the new of the sign remained broadly stable in between 2016 and 2020, while the share of low-income individuals declined. Here it's important also to stress the difference of the values of the degree of income inequality between the old design and the new design. So according to the new design, the degree of income inequality is much higher in terms of Gini index is a jump of around the 6 percentage point. The value of the new design is indicated by this red triangular, while there is no significant difference in the share of low-income individuals computed with the old sample design or with the new one. This is somehow reassuring for us that one of the main aims of our methodological change has been achieved, in the sense that we wanted to better grasp the upper part of the distribution without altering the bottom part of the distribution. Turning to wealth, average net wealth in real terms rose by around 2%, was driven mainly by financial assets, while the real part, the real component decreased due to lower house prices. You can see that the gap between the mean and the median net wealth widened in the period. This points directly to, in this case, an increase in the inequality in the distribution of the net wealth, which is confirmed here by the steep increase both of the Gini index and in the share of assets held by the top 10%. So let me have a closer look at the trends in the average value of net wealth across the distribution. In this slide, we have the left panel, which focuses on the poorest 30% of households in terms of net wealth. The right panel, which focuses on the richest 5%, and the central panel, which focuses on the central classes. What we see is that the average wealth of the richest 5% is up by over 20% from 2016, driven by financial assets. Sorry, let me notice that the scales of the three panels are very different, so they are not directly comparable. So we have this jump in the net wealth of the top 5%, driven by financial assets mainly. Also, we recorded also an increase in the average value of net wealth of the poorest 30% of households, which nonetheless still have a negligible share of total assets. While for central classes, we recorded a decline in net wealth, which is mainly due to lower house prices, and since real estate make up the largest share of their wealth. Turning to debt, we see that we have, for the first time after the great financial crisis, an increase in credit market participation. The share of indebted household according to the new design, is around 28%, which, despite the increase, is still a percentage well below the average of our euro area countries. Anyway, despite this increase in the share of indebted households, we have a decline in the share of financially vulnerable ones, and this is due mainly to the reduction, to the lower interest rates that have been prevailing in the 4 year, but also because of one of the measures adopted to cope with the pandemic, in particular debt holidays that have been obtained by 7% of indebted households. So to conclude, the main message, we have income growth, which was stronger at the bottom of the distribution, while income inequality remained broadly stable. But both results largely depends on the new income support measures adopted, some of them temporary, other at least meant to be permanent in the period. As for wealth, we recorded a mild growth driven by financial wealth. In this case, we have an increase in inequality, which is due to the different portfolio composition across the distribution. Despite the increase in the share of indebted households, there are less vulnerabilities, also thanks to the measure adopted during the pandemic. Finally, according to our new design, we have a picture of a country which is more unequal than it was previously thought. And with this, I'm done. Thank you.
Thank you very much, David. We can turn immediately to the third presentation to Spain, head by Laura Crespo, who is research economist at the DG Economics, Statistics and Research of the Banco de España, where she is currently unit head of the Survey of Household Finance Unit within the Division of Microeconomic Studies. As such, she specializes in the design, production and use of survey data as part of the team that conducts the survey. Her research interests include intra-household decisions, household finances, health and population aging, as well as survey methodology and data comparability. So, Laura, the floor is yours.
Okay, thank you very much, Jan. Hi, everyone. First, I would like to thank the organizers for the invitation to participate in the workshop. I'm very pleased to be here with you. So in this presentation, I'm going to talk about the Spanish average household finances, the EFF in its Spanish acronym, in particular about its 2020 edition. So first of all, I'm going to provide a very brief summary very quickly, or description very quickly on some important methodological aspects of this edition. Then I will jump into a very brief summary of some of the most important descriptive results from this edition and the most significant changes with respect to the previous waves on income, wealth, assets, and debts. And finally, I would like to devote some time at the end of the presentation to show you some main takeaways from a particular analysis that we've been working on during the last months using the information from the COVID module that we specifically included in the questionnaire in this 2020 edition in order to collect additional information to assess the impact of the pandemic on the economic situation of households through employment losses and income reductions. So let me start by mentioning that this is the 7th edition of the survey, the 2020. Following those of 2022, 2025, and so on and so forth every 3 years, until 2020 when we transited to a biennial frequency, so that we have just, well, in July we just finished the fieldwork of the 2022 wave. So the interviews were collected from mid-November 2020 until the end of, let me see if I can, I have some. Okay, that's fine. So the interviews were collected from mid-November 2020 until the end of June 2021, following the standard calendar period of the survey. However, due to the pandemic mobility and health restrictions, we had to change the interviewing mode from face-to-face to telephone. And this forced us to implement from the very beginning of the fieldwork a very continuous and strict monitoring and comprehensive analysis of several indicators of data quality, which showed at the end that the comparability of the data from this edition compared to the previous waves was not compromised seriously by this change in the interviewing mode. So at the end of the day, we can say that the EFF 2020 provides a representative picture of the composition and distribution of assets and debts referring to the end of 2020, except for the annual income that refers to the previous calendar year to the survey, as usual. So the number of valid interviews that we collected was 6,313 interviews, and out of those, almost 61% corresponds to Banque households, which are basically households who were interviewed in the previous wave. And as I said before, the questionnaire, in the questionnaire for the 2020 edition, we included a specific and new section in order to collect additional information about the impact of the COVID-19 crisis on the economic situation of households, as I will explain you later at the end of the presentation. So let me move to the summary of some of the most important or the main descriptive results of this edition and the most important changes observed with respect to the previous waves. And let me start with the household income, which is expressed in gross and annual terms, and it refers to the previous calendar year to the survey. So the first thing that we observe is that the economic growth between 2016 and 2019 led to important improvements in household income. In particular, in this period, we observed that the average income increased by almost 11%, and the median income by 14%, which are very important increases. And in general, we observe important increases for most of the groups, but still there are some important heterogeneity or remarkable differences across groups. For example, as it is shown in the graph in the slide, where we have in the red bars, we have the variation in the median household income between 2016 and 2019 along the income distribution. And as you can see, we observe important increases for all income groups except for the households in the bottom quintile of the income distribution, for which the median income hardly changed in this period. And this is a very different picture to what we observed in the previous period from 2013 to 2016, which are represented by the blue bars, in which we observed important increases in the median household income for all income groups, especially for households in the bottom quintile, the two bottom quintiles of the income distribution. With respect to the net wealth, as in the case of household income, we observed that between 2017 and 2020, it has grown in the last years. So in fact, the median in this particular period, the median net wealth grew almost 5%, which means a reversion in the downward trend observed since 2011. Since 2011 to 2017, there is an accumulated decline of 27%. So this is reverted now in the last 3 years. But again, as in the case of household income, we observe that this increase the increase observed for the overall population of households masks important differences across households, across groups, as you can see in the graph, where we can observe important increases in the median of the net wealth for almost all groups, again with the exception of households in the bottom quartile of the net wealth distribution, for which we observe an important decrease of 40% until 400 euros by the median, which is a very low level. So following with the net wealth and thinking about inequality and putting a more historical perspective, one of the most important phenomena that we observe is that the concentration of net wealth has increased continuously since 2002. As you can see in the graph in the left-hand side, where we have 3 different concentration indices. In particular, we have the percentage of the overall net wealth that is owned by the top 10%, the top 1% in blue, the top 5% in red, and the top 10% in orange. And as you can see, the 3 concentration indices have been continuously and monotonically increased during this period from 2002, during these almost 20 years. However, if we put it in a more international perspective, and plotting, for example, the ratio between the 18th and the 20th percentile using data from the HFCS for 2017, we can see that wealth inequality in Spain remains in relatively low or moderate levels, especially if we compare with countries such as the Netherlands, Finland, or Germany that exhibit much higher numbers. And this is due, of course, to the important differences that we observe among countries in terms of the ownership rate of the main residents. Regarding this and related to real assets between 2017 and 2020, the most important trend of change that we observe is that the percentage of households owning their main residence continue to decrease. And this is a trend that has been observed since 2011 in the overall population of households, as you can see in the graph, where the percentage of households that own their main residence has decreased from 83% in 2011 until 74% in 2020, which means 9 percentage points of decrease. And this trend has been even sharper and more remarkable for households whose head is under 35 years old, the youngest households, for which this fall has been of 33 percentage points, which is a very huge change and decrease. And another point that is observed in terms of real assets, which is also very specific of the Spanish context, is that 1/3 of households own a dwelling that was not their main residence. And this number is very similar to the one that we observed in the previous wave. So regarding financial assets, we observe two phenomena or two important changes. One is very much related to the pandemic and has been also observed in other countries, and is that the median balance of bank accounts for making payments increased very substantially for the overall population of households, in particular by 54% overall. And we observe very important increases across the board in general for all groups, except for those who are particularly vulnerable, such as households whose head was unemployed or economically inactive, for which we observe very small increases, and households in the bottom quintile of the income distribution, for which the median balance decreased, as you can see in the graph, by 5%, as opposed to the important increases that we observe for the other income groups. And however, on the other side, we observe that the mean of the investment, the mean balance of the investment funds fell in the overall population by 12% in general. And we observe also declines for almost all groups, with the exception of households in the top decile of the net wealth distribution, for which this balance increased very significantly by around 27% overall. Okay. Now, regarding debts, the most important or two important changes or phenomena that we observe are that among indebted households at the bottom of the net wealth distribution, the value of outstanding debts associated to personal loans has been growing, personal loans which are basically debts associated to very small amounts, whereas in the upper part of the net wealth distribution, it is the value of outstanding debts associated to the purchase of other real estate property that had been growing. Okay, so this kind of difference in the composition of the debts and the changes in the composition of the debts. And these two phenomena, or these two changes, could be driven the fact that the decrease in the ratio that we observe between debt and household income for the overall population has been mainly concentrated among households in the two bottom quintiles of the net wealth distribution, remaining stable for the other groups. Regarding the burden and the financially distressed households, we observed basically that the percentage of households that pay more than, or that devote more than 40% of the gross income to the payments has increased very slightly in the overall population of households, just 1 percentage point. But this increase has been concentrated mainly in particularly vulnerable households, such as the lower income households, households whose head was under 35 years old, households whose head who was unemployed or economically inactive, and those households in the bottom quartile of the net wealth distribution, as you can see in the graph, and that has experienced important increases in this debt burden indicator between 2017 and 2020. Okay. So now let me move to the COVID module, and then I'm going to just to show you very briefly some takeaways, as I said before, from an analysis that we've been doing in the last months using this information. So this data, or this analysis shows that 28% of Spaniards aged between 18 and 64 years old and in the labor force experience some kind of employment shocks. That could be job losses or business closures, temporary reductions in the number of hours of work or salary, or have been on furlough between the beginning of the pandemic and June 2021, which was the month in which we finished the collection of the data for the 2020 edition. If we look into the duration of these employment shocks, around 50% of those affected reported to have experienced employment shocks longer than 6 months. And regarding the type of employment shock, the prevalence are the following. Among those affected, 44% reported to be having been on furlough. 26% experienced job losses or business closures, whether around 30% kept their employment, but with temporary reductions in the number of hours of work or salary. So this is the prevalence of employment shocks during the first year of the pandemic, more or less. Now what we want to do is to exploit the longitudinal information from the EFF 2017 and 2020, following the same individuals along the two ways, to analyze how these employment shocks driven by the pandemic that we have identified using the 2020 edition are associated to changes in particular outcomes, some of them related to the household's financial situation, such as labor income, household income, debts, or net wealth, but also changes in expectations and life satisfaction between 2017 and 2020, the last two waves. Okay, and let me just describe the main takeaways. So, with respect to the individual labor income, the median individual labor income, we observed, we obtained that it fell substantially between 2019, which is the pre-pandemic situation, and 2020, because to remind that for income we can observe the income for the previous calendar year. Okay, and also the income at the moment of the interview. So it fell substantially between 2019 and 2020 for individuals affected for more than 6 months, in particular by 55%, and those who experienced job losses and business closures, for which the median individual labor income decreased by 100%, as opposed to individuals affected for shorter durations or affected by employment shocks with shorter durations and not affected, for which we don't identify significant decreases in the median labor income. With respect to the role of public measures, such as unemployment benefits and other benefits associated to furlough schema, we obtain our results suggest that they play an important protective role, because once we account for them, once we include these public measures in the definition of the individual labor income, those faults that we have reported just before get reduced to 21% for those that were affected by employment shocks that lasted more than 6 months, and to 30% for those who experienced job losses or business closures. Okay, so it seems there was a protective role in these public measures and benefits. With respect to the uncertainty of future household income, which is measured by the standard deviation of households' subjective probabilistic expectations that we collect in our survey, we observe that for all groups, affected and unaffected, this uncertainty level increased between 2017 and 2020, but we identify more important increases among those longer affected, those who experienced job losses or business closures, and those who experienced reductions in working hours not covered by furlough schema, probably because they were less protected. With respect to debts, the main takeaway is that the median level of total household debt increased by almost 30% for those individuals affected for longer periods, for more than 6 months, and as compared to the other groups of affected and not affected individuals. And this increase is mainly driven by debts different from mortgages, in particular personal loans and debts associated to credit cards. And related to this, we also observed that this increase in total household debt for those that were affected longer might explain why net wealth increased by 8 percentage points less than for the other groups of individuals. And finally, just to finish, with respect to life satisfaction, which is a very important indicator for welfare, for individuals' welfare, we observed that the average life satisfaction levels remain stable between 2017 and 2020 for all groups, except for those who experienced job losses and business closures, for whom it decreased. It could be associated to the high increase in the uncertainty level of future income that we observed for this particular group, and also because of the fact that they were less protected by public measures. And that's all I wanted to show you. You have more details in the report that is uploaded in this link on the EFF 2020, and results on the COVID-19 effect will be available soon. Will be released soon in a Bank of Spain document in the next weeks. So thank you very much for your attention.
Thank you very much, Laura, for this indeed very interesting presentation. And Ernest, you have a question, so maybe you can just ask them.
Yes, thank you very much for these very interesting presentations. I find this very interesting to have this comparative approach between the various country presentations. Now, as far as I remember and understood, these were supposed to be the countries with a higher home ownership, right?
Yes.
So I found quite dramatic the one of the last pictures shown with the strong fall in home ownership among Spanish households, but particularly among the young ones. And I find this raises a broader distributional issue, but particularly a question of distributional questions among age groups. And to me, an immediate conclusion is, normally house price cycles are regarded as a question of financial stability concern or whatever. And macro-pru measures, we discussed about this a week ago, are then designed to, ensure financial stability. But it is also obvious that house price cycles also are a distributional issue across generations. And I think policy would be well advised to take this also into account in devising their policies and putting even greater emphasis on stabilizing house prices over time. Thank you.
Okay, so is it?
Yeah, just mention that I completely agree with Ernest, and this is a question of it's a question of housing prices, but also employment instability and wage conditions, which for the young people in Spain have been traditionally, especially in the last years, very not very in a very well situation, basically. So it's like the two factors that are playing a role here in the accessibility to and the affordability of young people to buy their own housing, their houses and residences.
Maybe just to underline that the picture in Italy is more reassuring because we had lower house prices, a small decrease in house prices, and a further small increase in the rate of home ownership that was more concentrated towards the younger people. This was not completely jumping the wealth net in their wealth because they accessed through mortgages. But anyways, in somehow even a good news to know that the young people can access the credit market as well, which is not always granted, especially in Italy.
Okay, I don't know if I should say anything from the perspective of Slovakia, but I mean, you could see that the wealth in Slovakia largely depends on the evolution of house prices, right? And we can see, I didn't show you the result, but we have another analysis basically showing in detail that zooming in or zooming at the young households, around 45 or 50% of them only can acquire their home via mortgage, and we can see that what happened to mortgages recently as a reaction to high interest rates. So actually it would be very interesting to see what the upcoming wave of the HFCS, which is actually already planned to be in the field within a couple of weeks, will bring. And as we shown that the households virtually, got much wealthier between 2017 and 21. So unfortunately, we anticipate that there will be like a huge drop in net wealth in Slovakia because of this year.
Great, thank you very much. I will have only one last question to David, because you showed the composition of the wealth of households in different wealth categories. And what was interesting that there was a decreasing wealth because of the main residence and because of the real estates. And I just quickly checked during the presentations that the official ECB statistics about the real estate prices in Italy, and to me it seems that the drop between 2016 and 2020 between the two waves was higher in the HFCS than in the official statistics. So there was some stagnation, but not as dramatic as you showed in the data. So is it because of the methodological change, or does it have to do anything with also what Andrej showed, that in general households tend to underestimate the price of the real estate? So it's something that was quite an interesting outcome for me.
Yes, I think both of them. I'm not able to say in which measure more one of the other one, but I think this, and also because I think the index that that is produced by our National Institute of Statistics, if you check, I mean, through Eurostat, I guess is that one, compromises also new dwellings, which pushed up the prices. The index is right to do so, but I'm not sure that how we are able to sample enough households who live in new dwellings that, as you can understand, in Italy is not so frequent because of artistic and constraints. And
yes, sure. Okay, so thank you very much. So with this, I would close the first three presentations and would like to turn to the next block, starting with France. Jean-Pierre is currently an advisor in the Monetary and Financial Statistics Directorate. He started working at the French Ministry of Finance before joining the Bank of France in 1993. A large part of his career was devoted to macroeconometric modeling and macroeconomic forecast. He has also been working for about 10 years on economic studies and statistics on the individual data of enterprises. He is also currently co-editor-in-chief of the Banque de France blog. So Jean-Pierre, please, the floor is yours.
I will not survey the whole situation in France, and rather we chose to focus on housing and household debt as an example of what we can do with HFCS data, and especially we wanted to look at the differences between countries, and also the differences between population groups within the same country on the basis of this data, and also in connection with macro indicator which can be available as regards housing. So my presentation, I will start briefly with some history of the survey in France and about methodological issues, but very rapidly because a lot has been said in this respect. And then I will go on my subject with comparing housing and debt in Germany, Italy, France, and Spain to give a focus on France. And I will finish on the review of some financial fragility indicators. So in the case of France, there has been a survey since 1986, which was carried out by the National Statistical Institute, INSEE. Previously, this survey was carried out every 6 years, and since 2009 and 2010, part of this survey is used in order to join the HFCS, and so the Banque de France is now part of the survey together with INSEE. We call this survey the wealth survey, but actually the full name is the Life History and Wealth Survey, and the survey covers questions about property, financial and professional assets, indebtedness, but also about the personal history of the household, questions on inheritances, on gifts, and also about the household formation and the professional career of the respondents, so that the survey at the end of the day can give information on wealth, on inequalities, but also on how wealth is built up and passed on. Regarding the methodology, especially in this in my presentation, we must keep in mind that the survey from one country to the other is not carried on at the same period, or not strictly speaking at the same period. It is not always damaging, but you must keep this in mind. Imagine in the case of a financial crisis, which can be very very strong and very quick survey run a couple of weeks before or a couple of weeks after can provide different answers to especially to financial questions, for instance. But with this in mind, in our case, this is not a big deal. With the 2021 survey, we experienced the COVID period. So we have said a lot already something about this for the countries and the France. In France, in the case of France, it was the same. We had to use telephone calls instead of face-to-face interview, and the survey, which was scheduled to be done between September and December 2020, was actually done between October and 2020 and March 2021. Okay, and this being said, for the longitudinal monitoring of the survey, the last wave, 36% of the respondents were being questioned for the first time, and the sample is drawn from the tax file. 43% were interviewed for the second time, and 21% for the third time. Okay, so this being said, we can have a look at macro data. On the left-hand side, you have the property prices for the Euro area, Germany, France, Italy, and Spain. And on the right-hand side, you have the household mortgage rates for these countries. So what we can see from these pictures regarding the property prices is that we have some common features and some quite different features across countries. For instance, as regarding prices for Germany, we have an almost continuous rise in prices since 2007 or 2008, where for the other countries, you can see that we have something like somewhat of a fall after the financial crisis, and then a recovery thereafter, also at different speed and with a different timing. And in particular, we can see for Italy, for instance, a protracted period of low or stable property prices, where the rise in France or in Germany was stronger. And as regard interest rates, the general picture is common, a fall in interest rates, but looking at the details, we can see, for instance, in the case of Spain, that in 2016, when the interest rates were falling in the other countries, it remained quite stable and at a relatively high level in Spain, falling only at the end of the sample before the rise of 2022. So this overall picture, from this we can draw that very likely we will find differences across countries, and the survey can help in the analysis in this respect. So if we look at the property values as it is reflected in the survey, looking at for the 4 countries, looking at the first set of bars, which is the total. This total reflects more or less what we have seen on the global indicators. We have already touched upon the subject that what we can see, what the people answer in the survey does not necessarily fully match the actual data, but still we have some common features, especially in Germany, where is almost continuous rise I mentioned. But still we have, then if we look at the distribution across level of income, you can see that we have differences across brackets and also across countries. I must say that for Italy, you do not have the 2021 results for the reason mentioned by David. We did not correctly took into account all the methodological issues that he mentioned, and we were not in a position to correct properly the data. So instead of showing probably the good direction and changes of the data, but not the correct size, we didn't want to let you go with the wrong value of the data for Italy. So we will do the correction and make the results, the correct results available thereafter. So this being said, we can also guess from this picture that there are differences in the housing market regarding the quality and the location of the houses, especially as regard the top distribution of income. And this is also likely to drive differences in the level of debt. So again, a macro picture of what we have about the debt here is the household property debt by country in billions. So you can see that in Germany and France, the level is quite high and rising at strong speed, where in Italy, the rise was more modest. And we can see the fall in Spain, and for the various reasons explained by Laura, that we will see again in a couple of minutes. So if we look from the survey now, the breakdown of the household debt by type, we can see very strong differences. So about Spain, this is what Laura showed, that on the right of the picture, you have the whole types of debt, and on the right, the mortgage debt. So the difference is the consumer debt. And for Spain, for the mortgage debt, the percentage of households in debt is quite stable, where for and we can relate this to the housing market and the fall in the level of debt, but for the whole type of debt, the percentage of household is on the rise in Spain, and this is what we have seen. We've discussed the consumption debt, which is increasing. For France, the level is on a steady rise. And in Germany, it has fallen from 47 to 41%. And this, if we were to look at across income scale, we would see that this is largely spread over the income scale. Now, if we have a closer look at the situation in France, so I mentioned the apparent stability of the percentage of household with mortgage debt in France, but looking at the distribution across levels of income, we see that the picture can be very different. Especially, it is on the rise for the top of the distribution, especially the top 5, but also for the first time with the last wave of the survey, we can see that for the bracket 75 to 90%, we can see the rise for the first time. And together with this rise of the share of household with mortgage debt, we can see the rise of the median mortgage value. So this we can see here the concentration of the indebtedness over the highest the highest income on. And to finish with, I wanted to show you this fragility indicators, where again we have differences across countries, where in Germany and Spain they remain stable, or if they did not decrease. And especially you can notice in Spain the fall in the debt to income ratio in connection with all the analysis of the situation on the housing market we have mentioned for Spain, where for France it's on the rise, especially the debt to income ratio. So to finish with this, what we wanted to share with you, the richness of this survey, which can be related first to macro development and to go deeper in the analysis of the macro development, and not only in a given country on the various ways we can have to break down the data, but also across countries. So, and as I said, we will share with you the correct result for Italy, and very likely we will also write an article in the monthly bulletin of the bank by the end of the year about this topic. Thank you very much.
Great. Thank you very much, Jean-Pierre, for this very interesting presentation. And now we will turn to Austria, where Pirmin Fessler will present. He is a senior economist at the Austrian Central Bank. His current research focuses on private household finance, financial literacy, household portfolio choice, and household financial vulnerability. He has also published in influential journals such as the Review of Economics and Statistics, the Journal of Economic Inequality. He has won several prizes for his research, such as the Tony Atkinson Award, and he is also an advisory board member of the Luxembourg Income Study. So, Pirmin, please, the floor is yours.
Thank you. Thanks a lot for having me. I will jump right in. I think I mean I listened to your presentations carefully, which were very interesting, and I think I will try to also kind of respond to some things or focus more on some things which came up already during the talk. I first want to start by saying that I think it's very important to remember why we have these surveys, right? So we have them because we need a kind of benchmark about the household population. I mean, administrative data is very important, and I think it's also very important for these surveys to open to administrative data and let administrative data feed into them. But we really need to keep them, and especially the quite high and extensive and expensive methodology, because we want to have a probability structure in our samples where we can really talk in a more or less arguably representative way about the households in a certain country. And that's very difficult with other register data. A second reason why we have them is that our economic models are all focused on decisions of individuals, of households, and so on. And for the decisions, what counts is subjective expectations, preferences, and all these things. And you cannot gather these things without asking the people about them. And that's also the reason why I will start actually with a little taste of research, as I called it, to explain to you why I think this subjective perspective we can have from surveys is so important. Then I will talk a little bit about the household's balance sheet in Austria, about asset participation across the distribution, and also the joint distribution of income and wealth, and another reason why the surveys are so important, I think. So first, quickly, we have a question in the Austrian HFCS where we ask the people about what they think where the position in the net wealth distribution is. And as you can see here, most people believe they are somewhere in the middle of the wealth distribution. That's kind of not a big surprise, because we all kind of live in our reference groups, and therefore we experience not the full the full wideness of the distributions, especially in the upper deciles. Like hardly anybody thinks that he or she is in the upper decile of the distribution. There's a strong tendency to think of yourself as being somewhere in the middle. And why is this important? I can show you some recent piece of recent research we do. It's about the perceived wealth rank and the saving rate. I mean, there are a lot of macro models these days which put wealth into utility functions and also relative wealth in utility functions. And what we did here is to look at this under or overestimation or correct estimation, and we see it really matters for the savings rate of the households. And this effect is very, very strong. And we can also run an IV regression where we look at some policy we had in Austria to see if it is causal, and we find very, very strong effects. And I think that is very important because you can see that logically, kind of, rational decisions are based on beliefs, and the household or the individual itself does not observe the objective information, but has an idea about how the economy and the society is, and that is what shapes their decisions. And that's not only at this core decision of savings and consumption, but it's the same with buying a house or renting a home and so on and so forth. And I will come to this later, but I think it's very important that we don't forget it's not about exactly getting, not only at least about exactly getting the values right, but it's most interesting to know what does the person think the house is worth, right? That's a very important information because all the decisions the household will make is based on this belief and not on some assessed true value of the house. You can only observe if there is a market transaction anyway, actually. So from that right into the distribution of net wealth in Austria. So you can see here it's very skewed, of course. The means and medians are were in 2021 around 200. Mean around 200 to 300,000 euro. There was quite some change in wealth levels between 2017 and 2020. It happened mostly in the upper half. So basically, the upper half got more equal. I really prefer these figures to any like Gini coefficient or other inequality measure, because here you can see like what happened at different parts of the distribution. So in Austria, the upper half got more equal. Why was that? Because house prices went up, and for the part between P50 and P90, house prices is the main residence is just the dominant asset. So that's why relatively they gained more wealth than the people at the top, and that decreased inequality in the upper part. And then, of course, as you might notice, we cut this off at P5 and P95 just because our data is not very good at the very top of the distribution. So measures of the share of the top percent or so come with very low precision. And yeah, I'm not so much in favor of analyzing this stuff only based on the HFCS data. Of course, you can do stuff with additional assumptions, but their recent work, also by colleagues from the central bank, but also by other people, shows that it's a lot about the assumption than what you get in these top shares. Then the balance sheet, and here I want to focus on some things which were important now in this workshop. So you can see the main residence is owned by about 47.6%, right? And if you, this is one of the most important assets, of course. Yeah. There are other real assets which are more common, but vehicles and things like that, but the value is much lower. So also important, of course, other real estate property and investment in self-employed business, but that's a much smaller share of the population. And savings account and stuff like in general financial assets is very conservative in Austria. So only very few people, I will come to that later, hold risky assets. And that has to do, of course, also with the large welfare state in Austria. That's also a reason for the low net wealth in the lower part of the distribution, I would say, and also a reason for this like huge risk aversion, because people have a state-funded pension system, they have a state-funded health and education system, they have a state-funded childcare system, and they have a state-funded unemployment benefits and things like that. So for the lower part of the distribution, there's not much need, you could say, to invest a lot in financial assets for precautionary reasons. And then also they can't, because they have to pay a lot of indirect taxes and insurances to cover all the things organized by the state, of course. But now we come to debt, and I think that's very important, because we talked about today already about the increase in house prices, and of course also the increase in debt. And this increase we could also see in Austria, especially during the COVID pandemic. And what we can learn from the microdata, which I think is very interesting, is that not only from the HFCS, but from other data as well, we know that actually home ownership did not increase in Austria, not at all. It actually decreased in the last 20 years a little bit. And also this recent increase in debt to buy real estate was not an increase in debt to buy your own home, but it was actually an increase in debt to buy other real estate properties. So the increase is not due to new homeowners or new owner occupiers, but it's an increase which is due to owner occupiers who use low interest rates to build up debt and buy additional real estate. Yeah. So it's not easy to distinguish that in macro statistics, because usually you don't have the information if it's about additional or additional real estate or home ownership. But it's of course very important for financial stability. Yeah. You can see that this housing status, so this figure shows basically the share of people who live in an home they own, they rent, or are free users. So basically that's very typical in Austria, especially recently, that people who already give gifts, they gift their own home to their children, and they live in their home for a while, and many of them are free users. And then also on the other side you have students living in apartments who are owned by their parents and things like that. Yeah. So you can really see that it's basically split in two parts. In the lower half of the net wealth distribution in Austria, you basically have mostly renters, and in the upper half you have mostly owners. Is that bad? I wouldn't say so. I mean, a large rental market, I mean, we will hear the presentation in Germany also. It has a strong, of course, influence also on household formation. So in Austria, we have very many young households who are single person households living alone in a very cheap rental apartment in the city. And also on the other side, we have many elderly who still live alone, not in a home with in a home for the elderly or with their family, but who live alone in a rental apartment. And I think that's also a sign. Must not be only a sign of affordability of these people, but many young people for a longer periods than it was 20 years ago stay in education, are very flexible, want to have flexible jobs, want to be able to move, and they just stay in rental apartments for longer if they are available. So this is both. There's a thing with affordability, of course. We can also see that this distinction here gets sharper in the middle of the distribution. And that more and more people can only afford the down payment if they get a gift from their parents or some other support or inherit something. But at the same time, it's also a sign of a change in household structure. So just smaller households are getting more and more common, especially one single person households, and especially the young stay for longer periods in single person homes. So that's why I think also this information, the huge amount of information we have on households, like hundreds of variables, is very important to get understanding what's behind macro developments. Here you can see the participation in Austria in risky assets, which is unfortunately, I would say for many reasons, very low. And it's really interesting to see that it's actually only the the people in the upper part of the net wealth distribution who start at least owning, a significant share of them owns risky assets. But even at the very top, like it's not a lot actually. It's that if you look here, you can see at the 80th percentile, it's still below 30% of the households who own any type of these three risky asset, mutual funds, stocks, and bonds. What you can also see, and what is very typical, that because it's the long puzzle in macro, right? That people actually also don't hold the share of risky assets in their wealth they hold is not rising with wealth. It's actually pretty stable. And this pattern you can see in many other countries. And interestingly, it's in some countries it's at 30%, in some it's at 40%, in some at 60%. It must have something to do, I think, not only with the pension system, of course, but also a supply story where it's really the bank council for a certain share of your financial wealth to put in these kind of assets. Very interesting, and also like I think a big advantage of this type of surveys is that you can really look at the joint distribution of income and wealth. And of course we have nice 3D figures also, but I personally like this thing very much, which shows you this table, basically the potential sources of your wealth, which is mostly income and then saving from income, inheritances, and then certain types of income which is not your labor income, yeah. Namely, if you hold other real estate and you can rent something, or if you have a business. And you can see here this is sorted by actually pretty similar groups as the ECB does now. So below P50, from P50 to P90, and above P90. And this is for both wealth and income. And you can see that there is a strong correlation, of course, between wealth and income, but it's not perfect. So you have very wealthy people in the lower half of income, and you have very high income people which are in the lower half of wealth. Yeah. And what you can see is that actually of course, ownership of your home, share of owner occupiers is, as I showed before in the figure, very, very large in the upper part, everywhere above 80%, where it's very low in the lower part. And that, of course, then has to do with households who already have inherited. That increases ownership a lot because it helps you to get the down payment. And it increases also your saving rate, because paying back your loan is a part of saving, so it forces you to save more, kind of, and so it translates to the chance. I mean, additional to, of course, the tax situation being much preferable for those people who live in their own home. It helps you to build up wealth that you are forced to save. And then you can see that additional real estate, the prevalence of this, and with that comes the potential, at least, to get a rental income. And one can also show that is very, very highly concentrated, only happens in the top 10%, basically. So the participation in holding other real estate is very, very, all other real estate than your own home, at least, is very, very low. But in the top 10%. And if you look at that in values, it's even much stronger. The same is true for, of course, business assets. And I think that's already it. And I just want to sum up by telling you that we have this landing page of our new report, and there you find a lot of material. Of course, all the documentation about the questionnaire, the user guide, interview information, and all what you need, and a lot of the tutorials to use the data yourself if you want, and some key papers. And we will add stuff there in the next months, I guess. Okay, thanks a lot.
Thank you very much, Pirmin. It was really a very interesting presentation from a bit of a different angle. So now we will end our journey in Germany. So our last presenter is Tobias Smith, who is a senior researcher at the Research Center of the Bundesbank. He currently has the research focus group which coordinates the surveys of the research center. His research focuses on household finance, expectations formation, and survey methodology. He is also publishing in well-known journals such as International Journal of Central Banking or Journal of Money, Credit, and Banking. So, Tobias, please, the floor is yours.
Yeah, thanks for putting this together and to the audience for staying until the very end. So I'm gladly going to present some results for Germany. So some of the things that Pirmin said would certainly also apply to the situation in Germany. I will focus in my presentation more on the wealth dynamics as such and present a few descriptive statistics. I'm going to present it, but there's a big team behind it who has worked on the survey for 2021 in various compositions. So just to recap, so the title of the survey in Germany is Panel on Household Finances. It's part of the HFCS, but that's why we are also in this session. And we have 4 surveys so far: 2010, 11, 14, 17, and 21. Our survey has a large panel component, and we oversample households in wealthy areas. So a few words on the 2021 survey. So we had to initially planned to do the survey in 2020, but then due to the pandemic, we moved it 1 year back in the hope that some of the restrictions to contact households and things like that would be lifted by 2021. It didn't work out. So in 2021, almost all the interviews were actually then eventually collected by telephone, whereas the previous 3 waves, it was face-to-face, so interviewers going to the households and interviewing households there. Despite having to switch to telephone interviews, we kept the questionnaire almost unchanged. Interviewers were then asked to read some of the lists that we had used in the face-to-face interviews, so the questionnaire didn't change substantially, so we think you can compare the results across the waves still, despite the different method. And we have a Corona module. I will not report on that, but just to sort of address the current situation in 2021, we added this. In the end, we had 4,100 households interviewed. Like I said, a huge part of it panel, 83%. If you look at the average for waves 2 and 3, it was 60%, so a strong increase of the panel component. And just before we go to the results, it has already been mentioned by some others. I'm now 2 years out, or 2 years from the survey in 2021. We forgot that between 17 and 21, for most parts, the interest rates were low, inflation rates were still low, the house prices were increasing. You saw this already in the presentation from France and Germany substantially, and also the German stock market was up. And we think also for our results, the Corona measures implemented play a role, so it reduced consumption opportunities, and at the same, the government had implemented some programs to stabilize income, which you will see may have eventually, this combination of this may have led to extra savings being accumulated also by poorer households. Okay, so first the headline result, I would say that we always publish for each wave is to look at how did net wealth and develop, both the mean and the median, and you can see that both the mean and the median are substantially up compared to 2017. They have been increasing since we started the survey, but now we have a huge, a very big increase between 2017 and 2021, both in the mean and in the median. What's also needs to be considered here is that it's now 4 years. I mean, in previous waves, it was always 3 years between the surveys, and this is in nominal terms, so no inflation adjustment or anything. So there's 4 years now have gone by since the 2017 measurement. But this is certainly not the only reason for this big increase. It's also, if you look at the distribution in a broader sense, not just the mean and the median. If you look here, we look at certain deciles or borders of the deciles. You can see that this increase in wealth is not only pronounced for the middle of the distribution, but in absolute terms, you have also very strong increases towards the top. of the distribution. It's harder to see in this this graph what happens in the bottom part of the distribution. There have also been increases, and as you will see on the next slide, in relative terms, so relative to what those households held before, these increases were stronger than for the top of the distribution. So you had in absolute terms a larger increase, of course, towards the top of the distribution. But if you put this into perspective to what these households that had in 2017, you can see that in the bottom half of the distribution, there was relative to the assets that were there is a strong increase, and this is, if you look closer at it, or there's already been some talk about the home ownership rate. So usually the households in the bottom part of the distribution do not own substantial amounts of property. So this is mainly driven by an inflow to financial assets, which may have been the result, like I said before, reduced consumption opportunities. So they saved more of passively, maybe saved more of the income, and also we see a smaller lower debt levels for the households in the bottom parts of the distribution, especially consumption debt. What this then eventually led to, if you calculate the inequality measures, here I mainly focus on relative measures of inequality, so mean to median ratio or P90 to median Gini coefficient and so on. You can see that the inequality has slightly decreased, especially if you take the longer perspective from 2010 to 21. So over the last decade, you see a decrease in inequality in terms of as it comes to net wealth over the years and over the surveys. It's still, I mean, after it's on the next slide, but I can also mention it already here, still compared to other Euro area countries, the inequality is still rather high in Germany. It's also saw this, I think, from Laura's presentation. The interquartile range increased. That's, I mean, that you could also have seen from this picture already. But the relative measures decreased. So, but this interquartile range, I mean, it would also increase if everybody would relatively increase their wealth in the same amount, same factor. So yeah, we also, I mean, it's great that we have this workshop or seminar here on also having results from various countries. It's quite important for us also to sort of put the situation in Germany into perspective and have something to compare to. How is the median and mean net wealth, for example, distributed in the euro area overall or in relation to other countries. And as you can see, this has also been a finding now again for 2021, but has also been documented for the earlier waves, that the median net wealth is lower for Germany than the euro area average, and for lower also than several other countries. The median is higher, and has, I mean, with this strong increase now, even yeah, it's higher than in the euro area. In the past wave, it was always median much lower than the euro area average, and the mean closer to the average. Inequality, as I also already said, is measured by the Gini, but you can also take others of these relative inequality measures. Is higher in Germany than in the euro area in total, and also compared with other euro area countries, many other euro area countries. So we also ask regularly questions about savings motives, and this was also an interesting topic discussed also during the pandemic. Did households savings motives change? Did they save more than before? And here is a graph on the savings motive. So we see a small increase of households actually indicating that they regularly save a fixed amount, and in particular what also went down is in 2021 in particular is that fewer households actually say they were unable to save because they lacked the income to save, and this increase compared to 2017 was particularly pronounced in the bottom of the distribution. The savings motives, however, do not seem to fundamentally change over the years. So you see it's almost the same pattern. I mean, ups and down for specific items, but in all waves, the saving net or saving for emergency is the most important one, followed by retirement and major purchases and other motives like holiday and travel. Sort of, I mean, they marginally change from one year to the next, but not substantially. So at least in 2021, there's not. There doesn't seem to be a fundamental shift in the savings motives of the households. Yes, so I'm already at the end of my presentation. So I think one of the main findings of our survey was that the net wealth of households increased across the distribution. I mean, from the financial accounts and other wealth accounts, you already knew that the overall wealth level for the households had reached record highs, but what we can document with this micro data and looking at the full distribution is that this net wealth increase was not only at the top or certain parts of the distribution, but really across the distribution. We think that we can show that the net wealth inequality declined over the last decade in Germany, and we will continue to survey the households, so it will be super interesting to see what happens now, basically now in 2023 with all the changes like for interest rates, inflation, and so on. So we are currently still collecting data for 2023. That's the way forward. Okay, thanks. I also put email address here if you want to send us an email, and most of the results are you can also look them up in the monthly bulletin article from April, which I put the link in this presentation. So thanks for your attention.
Thank you very much, Tobias. So now we can open the floor for questions. I see that Pirmin has one comment.
I just want to make a comment because I think this is often a mistake a lot of people make, not Tobias, of course, but the people who are outside of the HFCS and deal with these euro area numbers. Yeah, one has to be clear that like if you look at the euro area average, that's something different than the euro area figures in the report. The euro area figures in the report are calculated based on the household weights of everyone in the euro area, every household, and is not an average across countries. And this is particularly important if you look at the Gini or so, because you could have a perfectly equal distribution in 3 countries, but if you put the countries together, it might be very unequal, even though the average of the countries, of course, would be very equal, right? So that's something which I often see is misunderstood when people talk about euro area average versus euro area figures. So the euro area figures are not at all the average of the euro area countries, and especially with Ginis and things like that, it's very difficult, of course.
Pull them all together and basically recalculate mean, median, and Gini.
Yeah. Yeah, thank you very much. I think this was really a very interesting point. Okay, so we have another question. So for all 3 presenters, how do you think the changes in monetary policy will affect household wealth in the coming month? I think it's a valid question, so maybe we can go in the order of presenters.
Yeah, I will give you my personal views on that, not the views of Banque de France. On the basis of what I've presented, where we have already seen a concentration of housing wealth and also housing debt on the high side of the income schedule. My views are that due to inflation and also to the rise in interest rate, we are very likely to see again this change, this move in terms of concentration over the richest household in the population. They will be the ones who will be able to afford the purchase of housing and to also be able to wear the load of a new debt.
Yeah, I mean, that's a very difficult, because it's a very complex question, but I just want to make a statement on one point, because in Austria we have this discussion about, like, in Austria there is a share of people, I mean, we don't have a lot of indebted people, but a share of people has variable interest rates, for example, loans with variable interest rates. And I think, relating also to what Ernest said, I think it's a thing between generations a lot, because now you have higher interest rates, which makes it extremely difficult for the younger people to buy a home, and which, with at the same time, high inflation rates, which lower the debt burden for those who are older and already have debt for quite some time, because it's especially the ones who are hit with the variable interest rates now. I mean, I don't think it's a huge problem, and I think they can afford that actually. But still, it's those who are hit are those who recently took up the debt. So it's within the people, within the households who are indebted, it's also the younger ones. So I think this high interest rates and at the same time pretty high inflation is a huge distribution from yeah, to like from young to old, basically, unfortunately. And that's something a policy should address, I think. The question is, how do you do that? Like, this is really difficult, I think.
Exactly.
So I think we have to wait and see. I mean, there are many things going on, as always. I mean, higher interest rates, profit the savers usually are the debtors may get into problems. But I mean, there are other things going on at the same time, like house prices are going down in Germany, here and there. Discussions about certain government support programs and so on. So I think it's really hard to say. And I mean, what the experience told us, I think, for the last 10 years is that also this wealth distribution things, they overall move relatively slowly. So I mean, you see some changes from one wave to the next, but to get sort of a fundamental shift, not even Corona seems to have, at least my view, fundamentally shifted. So sort of the basic structures we have seen in terms of the wealth distribution.
Thank you very much. So it was a very interesting question, because it's also a bit of an advertising, I think, for the next HFCS wave, which is to be, I think, conducted in this year, 2023. So we will see the impact of, like, energy crisis and also stricter monetary policy in the data. We are a bit over time, but maybe we have time for one more question that I see in the chat. So just let flow it spread around. With access to a lot of panel data, are there any surprising findings when interacting demographics and wealth? It means the great wealth transfer from older generation. It's open question if anyone feels like answering.
I mean, Austria, we don't have a panel, unfortunately, but I worked a lot with wealth panel data, and I can only say that, I mean, one issue is demographic of a household, right? I mean, people really underestimate. I mean, the households were stable 40 years ago, but today, within a few years, a household changes. You know, people move in, people move out, and it's really difficult to tackle these questions. So I didn't see any paper which really takes the changes within household structures into account and does something about that. But I think this is in general under-researched, like how the impact of household structure and changes in household structure on all these statistics is huge, and it's basically never accounted for, also between countries. I mean, you have to imagine in Spain, there are only about 20% single person households. In Austria, it's 40%. But we are calculating all these statistics at the household level without taking into account these basic facts like household size and things like that. And it's a very difficult topic, I think. Yeah.
Yes. Yeah, indeed. So thank you very much. So I think with this we can slowly end the webinar. I think we have raised a lot of very interesting issues and questions. Just to mention a few, I mean, we've discussed wealth distribution, income distribution, home ownership, rental market, indebtedness, and I think also a very important point raised by Pirmin is the mobility at all. That has an impact on a lot of things, and also financial literacy. So this is all that at least HFCS survey data can help us to try to understand and to try to answer questions in this field. So as you can see that when we start talking about HFCS, it's very hard to stop. But I hope that it was a good advertisement to the data and to the field, or to the research field that we all are interested in. So with this, I think I would like to thank to all the presenters, all the audience, and I think we can close it here.
Thank you very much.
Thank you.
Thank you.
Bye-bye.
Thank you very much.
Thank you.
For your attention.